Shockwaves are beginning to ripple across the financial world following the collapse of the California-based Silicon Valley Bank. It's the second largest failure of a financial institution in American history. A former Treasury Secretary warns that without government intervention, the whole venture capital sector could be wiped out.
It certainly is going to have very substantial consequences for Silicon Valley, for the economy of the whole venture sector, which has been dynamic, unless the government is able to assure that this situation is worked through.
Silicon Valley Bank provided financing for almost half of American venture-backed technology businesses. It was among the top 20 U.S. commercial banks with $209 billion in total assets at the end of last year. The collapse has global implications. Media reports claim some Brazilian firms with more than $10 million in the bank have lost their money. And that could be just the tip of the iceberg. SVB has also branches in India, China, and across Europe. In the UK, more than 180 companies have sent a joint letter to the British government calling for help.
The loss of deposits has the potential to cripple the sector and set the ecosystem back 20 years. Many businesses will be sent into involuntary liquidation overnight. This crisis will start on Monday, and so we call on you to prevent it now.
Now, parallels are being drawn to the global financial crisis of 2008. That was triggered by the collapse of what was America's fifth largest investment bank, Bear Stearns. Its exposure to the subprime mortgage fiasco led to the so-called Great Recession and the start of a domino effect of financial business failures. A recession in the U.S. economy was also seen as a key blame factor in the financial crisis. In an attempt to slow the economic downturn, the Federal Reserve significantly cut interest rates. But due to the loss of revenue and declining market confidence, more banks began to fail. Coincidentally, the very same person who directed financial operations for Lehman Brothers Global Investment Bank, the bankruptcy of which was one of the sparks for the 2008 financial crisis, also serves as chief administrative officer for Silicon Valley Bank. Professor of economics and politics Jack Rasmus told us that SVB's collapse is directly tied to the current U.S. strategy of curbing inflation by raising rates.
The Fed cannot raise interest rates high enough to bring down inflation because inflation is mostly supply side. They can't do anything about that. So they're trying to take inflation down by raising interest rates, in other words, crushing demand alone, right? But when they raise it up a certain level, between 5 and 6, I've been predicting you're going to start getting financial instability. And we see that already now. With the Silicon Valley Bank, because the tech sector is the most exposed right now. And, you know, there's like 250 companies that have their money in Silicon Valley Bank, a lot of them startups. And if that bank goes belly up and they lose that money, well, a whole bunch of startups are going to crash, right? That's why the government, I think, is going to really jump in and bail it out. And there's already signs they're doing it. But we don't know the contagion between Silicon Valley Bank and other tech financial funders and other commercial banks that fund these tech banks. You know, the tentacles of contagion are very widespread, and we don't really know it because these debt tentacles are always very opaque, you know. We saw that back with the housing sector crash. And we're going to find out over the weekend, or start to find out, what are the contagion potential here for the collapse of this bank, a very important bank. And it'd be interesting to see what happens on Monday, both in the financial markets, stock and bond markets, and also all next week, because we're beginning to see it will leak out step by step, I think, on what the contagion is. And it may shut down the funding of startups in the tech industry for a while. So, you know, it's all traceable to the Fed interest rate policy and Biden's policy of attacking tech Chinese technology and trying to get businesses to come back to the U.S., which is part of the geopolitical. The problem with Biden is that it's all geopolitics. And what happens to the economy be damned, really, as the U.S. tries to ring fence Russia and China and the other countries who may align with them. The U.S. is bifurcating slowly the global economy, the global capitalist economy. But it's all because of geopolitical objectives, I believe. And it's going to be a big price to pay, I think, eventually, by a couple of years from now. I think that's too early, much too early to say that. And unlike in 2008, boy, the government is jumping on this thing, ensuring bailouts and so forth already within 24 hours. They learned their lesson of not dragging their feet back then. I think one of the consequences, if there is contagion, is the Fed's going to stop raising rates. Because they're going to take care of the financial sector first. And that means inflation is going to stay high, 3, 4, 5%. It's not going to come down. So they're between a rock and a hard place. Do they try to keep bringing inflation down by raising rates, or by raising rates, do they cause further financial stress? The Fed doesn't work very well. The policy doesn't work very well anymore in the 21st century, where you've got a globalized, financialized world economy.
Swiss shares this week raised concerns across financial markets in Europe as major indices fell on contagion fears. Across the board, big banks were affected as well, with the banking sector down by 13% this week. Goldman Sachs predicted financial institutions would remain under pressure until a comprehensive approach is implemented. US markets are dealing with the fallout as well, with banks being propped up with $100 billion bailouts by the Federal Reserve and the Treasury Department, which are using all the tools at their disposal to mitigate the crisis. A recent study said that more than 180 US banks are in danger of collapse due to uninsured deposits. While the government's cash infusion has helped prevent a meltdown, the Fed's failure to disclose all the banks receiving aid has caused rumours to swirl and has led some market watchers to express fears of a possible repeat of the 2008 crash. Well, amid the concerns, RT correspondent Caleb Maupin examines the current upheaval in the US banking system.
The U.S. financial system has been shaken up pretty badly, with news of bank failures splashing across the headlines this week.
This is the biggest failure since 2008. It's actually the second biggest failure ever since Washington Mutual in September of 2008.
Meanwhile, Signature Bank marks the third largest bank failure in U.S. history.
Capital Corporate is now announcing their intent to wind down their operations and voluntarily liquidate Silvergate Bank.
This was a week of bank runs, starting out with the collapse of Silvergate Bank, followed by SVP and Signature Banks caving in. This caused lots of market turmoil. 3 banks went down, one right after another, and this caused panic among investors and depositors. The U.S. financial institutions saw their stocks plummeting. U.S. officials are trying to reassure the public that their deposits are safe. Extra liquidity is being provided to banks in order to keep them afloat. Joe Biden woke up early Monday morning to make a speech and give everyone a lesson on the laws of capitalism.
Depositors will have access to all of their money starting Monday, March 13. No losses associated with the resolution of Silicon Valley Bank will be borne by the taxpayer. Finally, the Federal Reserve Board on Sunday announced it will make available additional funding to eligible depository institutions to help assure banks have the ability to meet the needs of all their depositors.
Investors in the banks will not be protected. They knowingly took a risk, and when the risk didn't pay off, investors lose their money. That's how capitalism works. Let me repeat that. No losses will be borne by the taxpayers. Instead, the money will come from the fees that banks pay into the Deposit Insurance Fund.
So how is all of this going to play out? Here's what we've seen so far. The banks that were left cash-strapped have now borrowed $300 billion from the Fed. Almost half of that money went to holding companies for Silicon Valley Bank and Signature, two of the banks that just collapsed and caused panic on the market. An additional $153 billion was borrowed from the Federal Reserve last week. This comes through a program called the discount window. This allows the banks to borrow for up to 90 days. Now, typically, the program only provides $4 to $5 billion. But last week broke records. More money has been given out than ever in the history of the program. The numbers have already surpassed the 2008 crash. So now the Fed is back to printing money, providing banks with additional liquidity. But the Federal Reserve is also continuing its fight against inflation, and this is going to make that much more complicated. It's a fragile balance between curbing the problem of inflation and propping up the financial systems.
Now, the problem with this bank is they had over $250 billion on their balance sheet, but they'd actually lent out $249 billion. So that doesn't really leave that much of a cushion, right? Let's say if something happens. So obviously what happens? The US hiked interest rates, as we've covered a lot on the program, and that obviously makes the debt that they're holding on their balance sheet, which was a lot of it was in US government bonds, worth less.
So this is a really key point. You're talking about the interest rates, right? I mean, this is a key and critical point.
Yeah. So as those interest rates are rocketed, the debt that they have lent to the US government becomes less, right? So that left this bank with a deficit on their balance sheet of about $1 billion. Now, once that happened, the bank did exactly what the guidelines say, I would say. The CEO acted the same way. He said, well, I need to go and raise that $1 billion now to make sure that my bank is in the black. Now, what happened when he did that? That spooked a huge amount of people who have money in the bank, companies mainly, who then there was what we'd call a run on the bank. So about $13 billion was withdrawn from the bank.
Really?
And at that point, the bank was totally broke, right? So then the regulator and the government had to step in and take over.
Europe is now feeling the aftershocks. Credit Suisse took a tumble, and the Swiss central bank stepped in to give them a lifeline. The financial world is now holding its breath, waiting to see who's next. Caleb Maupin, RT, New York.